If you want to know what a company is really worth and, where it's actually going, you don't read the glossy investor deck.
No, definitely not.
You read the published financial statements. It's the definitive blueprint, really, of corporate health.
It absolutely is.
Yeah.
But let's be honest, it's often dense, maybe a bit overwhelming, loaded with jargon.
Yeah, exactly.
That's where we come in. This deep dive is kind of your shortcut. We're decoding the complete set of published financial statements used by global companies.
Okay.
And we're not just, reading a checklist. We're focusing on the structure, the preparation techniques.
Yeah.
Basically tells the true story.
So you get the insight you need sort of instantly on external reporting.
That's the goal. PO7, being well-informed.
Right. And under these global standards, IFRS, it's not just one document, is it?
No, not at all. You need the full set to get the whole picture.
Yeah.
There are 4 core statements, plus all the notes and policies.
The 4 pillars, we call them. So the statement of financial position.
Yep, the SFP.
The statement of profit or loss and other comprehensive income. So PLOCI.
So POCI.
So PLOCI, that's the one.
Statement of changes in equity. So CI.
Mm-hmm.
And the statement of cash flows. SCF.
Those 4, plus the notes, they're all linked. They tell a story together.
Okay, so where do we start?
Let's start where any good analyst does. The statement of financial position, the SFP.
The corporate selfie you call.
Exactly. It's a precise snapshot. Assets, equity, liabilities, all at one single moment in time.
Okay, let's unpack this snapshot then. Structure's key, you said.
Yeah.
And it revolves around time.
Yeah, time is crucial. Specifically, expected liquidity and settlement. The standard format recommends listing non-current assets first.
Long-term stuff.
Right. Your property, plant, equipment, goodwill, other intangibles, things you hold for the long haul.
And after that.
Then come the current assets. Cash, inventories, trade receivables, things you expect to use or convert to cash relatively quickly.
And this distinction, current versus non-current, that's like the fundamental definition for liquidity, right? It really is. It's the bedrock of the SFP because it tells you about the company's short-term financial muscle.
Okay, so how is current actually defined? Is it just 12 months?
Mostly, yes.
Yeah.
An asset or liability is classified as current if it's expected to be settled, realized, or, consumed within 12 months of the reporting date.
Okay.
But, and this is important, there's a key addition, it's also current if it's part of the entity's normal operating cycle.
Ah, even if that cycle is longer than 12 months.
Exactly. Think about, say, a company building large ships or something. That might take 18 months, maybe longer.
Right. So their work in progress inventory for that ship
is still classified as current, even though it's over 12 months out, because that 18-month cycle is their normal business flow.
That makes sense. It does challenge the simple 12-month rule a bit, but I see why. It's about the operational reality.
Precisely. It reflects the natural rhythm of that specific business.
Okay. So moving to the other side of the SFP equation, equity and liabilities.
Sure.
How do they stack up?
Equity comes first, usually. That's the owner's stake. You've got share capital, retained earnings, all those past profits kept in the business, and then various other components.
Like revaluation surplus or share premium.
Exactly. Things like that. Then below equity, you have liabilities, and they mirror the asset split. Non-current liabilities first.
Long-term debt, deferred tax.
Followed by current liabilities.
Your everyday bills, basically. Trade payables, short-term borrowings, provisions.
You got it.
But the standards are pretty strict about just lumping things together, aren't they? This idea of aggregation versus disaggregation.
Oh, absolutely. You can't just hide things in big, vague categories. The rule is items with shared characteristics. You aggregate them, combine them for clarity.
Okay.
But, and this is key items that do not share similar characteristics. They must be shown separately, disaggregated.
Why do you insistent?
Transparency. It forces companies to be upfront about significant or unusual items that could affect a user's judgment.
So if I see a huge line for other operating expenses, I should raise an eyebrow.
You probably should, yeah. The rules push for specifics. What kind of items must be broken out?
Good question.
Well, the sources highlight things like impairments of big assets like PPE, any major restructuring costs,
Okay.
provisions for big legal battles, for instance, or if they reverse a provision they booked earlier, lease liabilities are another big one now, and changes in goodwill.
Stuff that tells you if it was a smooth year or a bumpy one.
Exactly. Was it normal operations, or did they face major, perhaps non-recurring events?
Got it. Okay, so that's the SFP, the snapshot. Now we need the movie, right? The story of the year.
Right. We move from the static picture to performance over time. That's the statement of profit or loss and other comprehensive income. the subpool OCI.
This tells us how we got to that end-of-year SFP position.
Precisely. It's the performance statement. And the structure is pretty standardized globally, which helps with the comparing companies.
How does it flow?
You start at the top with revenue,
Mm-hmm.
then subtract the cost of sales.
To get gross profit.
Correct. Then you take out the operating expenses, think distribution costs, administrative overhead.
Like rent, salaries, marketing.
Yeah, all that day-to-day running cost stuff. That gets you down to operating profit.
The core business performance.
That's the idea. After that, you adjust for non-operating items.
Like financing.
Exactly. Finance income or expense, like interest paid on loans. And maybe the company's share of profit from an associate, if they have one.
Okay.
That brings you to profit before income taxes. Then the final step.
Subtract the taxman's share.
Subtract the income tax expense and you arrive at the big number, profit for the year.
Now, I remember reading companies have a choice here, how they present this.
They do. Two options, basically. Option one, a single continuous statement that shows both the profit or loss calculation and the other comprehensive income stuff below it.
All in one go.
Yep. Option two, they can present a separate statement of profit or loss, finishing with that profit for the year figure, and then follow it immediately with a second separate statement that just shows the comprehensive income components.
Starting with the profit for the year figure again.
Exactly. It starts with profit for the year and then adds the OCI items. Either way, you end up with the same total comprehensive income figure.
Okay, let's talk about that other stuff, OCI, other comprehensive income. Why? Why does this exist? If a company makes a gain, shouldn't it just be in profit?
That's the million-dollar question, isn't it? OCI exists because certain types of gains and losses are deliberately kept out of the main profit calculation.
Why, though?
Well, the thinking is they might be too volatile, or maybe not realized in cash yet, or just not reflective of the core operating performance for that year. So they're held separately, directly in equity reserves.
So profit for the year is like core operational results.
Kind of, yeah.
And total comprehensive income, which is profit plus OCI, is the total change in the company's wealth from non-owner sources.
That's a great way to put it. Total comprehensive income, profit for the year plus OCI. It's the overall picture.
But OCI isn't all the same, is it? There's this complex bit, the reclassification rule. This feels important.
It is. This is probably the trickiest part of OCI, but it's crucial for analysis. It's the real aha moment.
Okay, break it down for us.
Basically, OCI items fall into two distinct buckets. Bucket one, items that will eventually be reclassified to profit or loss.
Recycled, sometimes called.
Exactly, recycled. Think of these as being in a temporary holding pattern in equity. They haven't hit the main P&L yet, but they will someday when a specific event happens, like selling the related asset.
Any examples?
Yeah. A common one is changes in the fair value of certain debt instruments that are classified as fair value through OCI. When you eventually sell that bond, the gain or loss accumulated in OCI gets moved or recycled to the profit and loss statement.
Okay, so they do eventually affect profit. What's bucket two?
Bucket two contains items that will never be reclassified to profit or loss.
Ever.
Never, ever. Never, ever. These gains or losses are considered more permanent adjustments to equity, reflecting changes in value that aren't directly tied to that year's operating transactions.
Like what?
The classic example is a revaluation surplus on property, plant, and equipment. Say a company revalues its land upwards significantly.
Okay.
That gain goes into OCI and stays in equity, usually in a revaluation surplus as reserve. It doesn't hit the P&L because, well, it's just an estimate on paper until the land is actually sold.
And selling the land doesn't trigger recycling for that?
Nope. For revaluation surplus under IFRS, it typically stays in equity, maybe transferred directly to retained earnings eventually, but it bypasses the P&L. Another one is fair value changes on equity investments, designated as FVOCI.
Got it. So looking at the ARN example you mentioned, they had profit for the year of $57 million, right?
Yes, 57.
But they also had a gain on land revaluation of $100 million in OCI.
Correct. That $100 million gain completely skipped the profit and loss statement.
So their total comprehensive income was $157 million.
Exactly. 57 profit plus 100 OCI equals 157 TCI.
That separation tells a big story, doesn't it? That $57 million profit feels, I don't know, more real or sustainable than the $157 million total.
That's precisely the insight OCI aims to provide. It helps you judge the quality and sustainability of the reported profit figure.
Okay, that makes sense. So we've got the snapshot, SFP, and the performance story, SOP, LOCI. How do we tie it all together, bridge the gap?
That's the job of the third statement, The statement of changes in equity, or associate.
The FLOM statement.
It is. It basically reconciles the opening equity balances at the start of the year with the closing balances at the end. It shows every single thing that caused equity to change.
And its main job is to separate out different types of changes.
Exactly. It makes one crucial distinction. First, it shows transactions the company had directly with its owners, acting in their capacity as owners.
Like issuing new shares to raise capital.
Yep. Or the opposite, paying dividends out to shareholders. Those are owner transactions.
Okay, what's the other category?
The second category bundles together all other changes in equity that didn't involve transactions with owners, and this is disclosed just as one aggregate number.
Ah, and that aggregate number for other changes is the total comprehensive income we just calculated from the SAW OCI, right? The $157 million in Aaron's case.
Bingo. That $157 million TCI flows directly from the performance statement into the SOCI, showing its impact on the different equity reserves, like retained earnings and the revaluation surplus.
And the SOCI would also clearly show the dividends.
Absolutely. Using Aaron again, the SOCI would show the opening equity balances, then add the $157 million TCI, and then explicitly subtract the $27 million in dividends paid.
Which reduced retained earnings.
Correct. So the SOCI proves how you get from the beginning equity position to the ending equity position shown on the SFP. It connects everything perfectly. It's the reconciliation.
Okay, makes sense. Before we wrap up the structures, we should touch on something important. Financial reporting isn't identical for everyone, is it? Especially when profit isn't the main goal.
That's a really vital point. The fundamental purpose of the entity changes the reporting focus. Think profit-oriented companies versus not-for-profits or public sector bodies.
Okay. So for a regular company, profit-oriented.
The primary aim is, well, profit, increasing shareholder wealth. The directors are accountable to the shareholders.
And they get their money mainly from
Loans, issuing shares, debt, and equity finance.
But for a not-for-profit, say a charity or a government agency, the goal is totally different.
Completely different. It's about providing a service, achieving value for money, being effective and efficient with resources. Managers aren't accountable to shareholders, but maybe to trustees or the government or the public.
And their funding.
Usually comes from donations, grants, government subsidies, not investors seeking profit.
So how does this change the accounting? They still need an SFP, right?
Oh yes, they still need to measure their financial position accurately, assets, liabilities, but the objective of the reporting shifts. It's less about profit performance and more about stewardship.
Stewardship, meaning
Right. Meaning showing how well management has used the resources entrusted to them. The financial reports need to help users assess the organization's effectiveness, its economy, its efficiency in delivering its services.
which means some standard profit metrics just don't apply.
Exactly. Think about earnings per share, EPS. It's a cornerstone metric for listed companies.
Right. Profit divided by number of shares.
But for a charity, it's completely irrelevant. They aren't trying to generate earnings for shareholders. The whole concept doesn't fit.
So you'd look for other performance indicators instead. Service outputs, cost per unit of service, things like that.
Precisely. The accounting standards have to adapt to help users make those kinds of assessments.
That's a critical distinction. Okay, let's try and pull together the key takeaways from this deep dive into the main statements.
Sure. I think the first big one is understanding that it's a complete set of statements. SFP, SOPLCI, SOCI, SCF, plus notes, and they all interconnect.
Right, you can't just look at one in isolation.
Definitely not. Second, that critical classification on the SFP current versus non-current. Remembering the 12-month rule and the normal operating cycle exception. It's vital for understanding liquidity.
And then the SOPL OCI and OCI. Understanding that profit for the year isn't the whole story.
You need to look at total comprehensive income and, crucially, understand the two types of OCI items.
Those that will be recycled to profit later,
Like temporary holding account.
and those that will not be recycled, permanent adjustments to equity.
Getting that distinction helps you assess the quality and sustainability of the reported profit.
So understanding this whole structure lets you look beyond just the bottom line number.
It does. You see the snapshot, the performance, how they connect, and ultimately, the total impact on the owner's wealth over the period. That's the goal of comprehensive reporting.
Which brings us nicely to our final provocative thought for you, the listener. This whole complexity around OCI, separating certain gains and losses from the main profit for the year, it really highlights a fundamental, almost philosophical choice in accounting, doesn't it?
It does. What truly counts as performance in a given period?
Exactly. Why are standard setters so insistent on keeping things like, say, that big unrealized gain on land revaluation out of the main profit figure? If you were deciding on a CEO's bonus, would you base it just on that operational profit for the year?
Or would you look at the total comprehensive income, including those OCI items?
What does that deliberate separation tell you about the perceived risk or maybe the sustainability of the company's core business model versus these other value changes?
Something to definitely mull over next time you're looking at an annual report.
Absolutely. Thanks for joining us for this deep dive.
Our pleasure. See you next time.
We'll see you next time.